Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. And today it is my pleasure and a privilege to welcome Noel Parnell. Hi, Noel. Am I pronouncing your name correctly?
You are, Mike. You are. Thank you for having me.
Thank you for coming on the podcast. You are a Philadelphia native. You've been involved in real estate for many years. It's kind of your journey and your passion. But before we jump into real estate, let's talk a little bit about you, your history. One of the great interesting things about you, you are a runner, swimmer, CrossFitter, jiu-jitsu, Muay Thai athlete, and you were a member of 2008 US Olympic team, specifically on the Paralympic team. So tell us a little bit about your journey. You know, you live in Philadelphia. This is your hometown, and we'll dive into real estate, but just a couple of words about Noel before we do that.
Oh, yeah. Again, born and raised in Philadelphia, had a track and football scholarship down south to LSU and then transferred. Took a shot at running professional, didn't make it. I still got chosen to help some other person out, and that's really big because that's what I do now, is that I help other individuals achieve financial dreams. So I always make that correlation of having somebody else meet their Olympic dreams. I'm all over really right now. I love sports because it always teaches us valuable lessons. You know, you need failure to succeed. So I'm always looking for, the hard test in jiu-jitsu, or, it might be weightlifting, it could be boxing or swimming. It's just kind of pushing your threshold. I think that always kind of builds that character, and you need it in this type of economic environment, particularly with real estate.
Yeah, I appreciate that. The physical fitness and supports mental fitness, and we are facing an economic downturn. The real estate is not enjoying high interest rates, and everybody's concerned with what's going to happen in the upcoming months or in years. So in the meanwhile, certainly mental strength is important, and mental fitness. So any other thoughts on this, or let's dive into real estate, sort of your journey in real estate, how you started and where you're at today?
Yes, let's dive in. I'm ready. So I got my start right after the Great Recession. I got laid off from GSK in North Carolina. And, two lessons I learned from that is that I didn't hate my job, but I didn't want anybody to have just the power to terminate me at any time any longer. And so I kind of Googled that moment, was like, how do the rich become rich? And it was like some metric, like 92% own real estate. And that took me on my real estate journey, moving on. And from that time, from about 2009 to 16, I acquired almost over 118 units by myself. And that was through Philadelphia. That was kind of doing rehabs, flips, triplexes, quads. And I looked at what is my other goal right now. And that's kind of through family, and then also other ambitions, is that, I want to buy into a sports team later on, and you can syndicate into sports teams. And so what I like to do now is, we want to help what I call white collar individuals that are very smart but have dumb money. And what I mean by that is that their money is sitting in their bank and their savings accounts, earning, right now savings are up, they're earning like 3 or 4%. But if inflation is at 8%, you do the math of how much your money is actually really worth at that time. So what I'm just doing here is saying, hey, there's other options out here, and I like to present them. And it may not just be for me, but that can be for other syndicators. I think that's what makes me a little bit different, is that I just want to put people in the best possible position. Because when it comes to syndications, I'm sure everybody gets the emails or sees the advertisements. It's about the jockey. What is their history kind of navigating through turmoil? How are they operating? What is their actual, track record going through a downside? It was very easy to do real estate between, my opinion, from 2014 to 20. Like, interest rates were dirt cheap. It was very easy to do real estate. Now, let me know how you're operating right now. Are you doing cash calls? where you over leveraging or over trying to over deliver on properties. I'm very, very, very conservative on the properties that we look at, and that's for reasons that I want to keep. I want to help people build. That's the main goal. They go as far as I go.
Yeah, I appreciate your journey and some really interesting nuggets. I love how you call it the white collar dumb money. I mean,
Yes.
we have to be very careful and respectful to many
Yeah. Yeah.
professionals
Yeah.
who make
Correct.
their living doing whatever, and their money
Yeah.
is sitting in the bank and not earning them a great rate of return. Although obviously with higher interest rates, the banks have
Correct.
started to pay more. Before it used to be 0.25%, and now you can actually get 4.5% in a bank. So
1%. Yeah, that's
it's
what I said. Just higher. You look at the money that Apple made. Apple's actually at the highest right now, the Apple savings account, and I think they did like 10 billion in almost like 2 weeks. That's very impressive. But what is that money actually earning? And I just give people a platform to understand they can do other things with their hard-earned money than just kind of blindly invest into their 401k that they don't know. Most people don't really understand what their money is being invested in through their Vanguard account. So I just give people lots of options. And I like I said, what's different for me is that while I do syndicate, I'm not necessarily looking for you to always say, guess what, you can invest with me. I know other great syndicators that I would recommend. I believe in abundance. So I'm not just saying, oh, this me, me, me. I know other great syndicators that have deals out here and that I invest in, and I try to teach people like how to vet their syndicators, what sort of some red flags that I'm seeing in syndications right now, particularly that I see, a lot of younger syndicators living off of acquisition fees. And so their main goal is to put these syndicates together based off an acquisition fee. And what happens is you leave your investor kind of hanging there. And you're seeing some of those things out there in the environment right now. And I just like to make sure people are aware of it.
Yeah, I appreciate you sharing that. Well, the environment drastically changed in the last 6 months. Boy, I mean, we're talking about day and night difference, and it started to change over a period of a little over a year with Fed pushing rates. But a lot of syndicators and operators are beginning to fail, and some of them
Yeah.
are failing hard. Then they're not able to execute. At the end of the day, raising capital is only a small portion of the success story. The big portion is execution, and execution has been really difficult. And if you combine that with what has happened with variable rates, a lot of people are getting crushed, unfortunately. So it's
Yeah.
it's going to be a bloodbath, and I hate to put it any other way. There's going to be
No,
pain,
that's
blood on the streets, and
and blood in the
what
water.
I
Yeah.
yeah, and of course, selecting people who folks invest with is critical. The right operators make all the difference today. The ability to solve problems, execute on projects makes meaningful difference. You can still be paid from the high interest rates, but at least the chances of success are improved.
It mitigates it. I always say, like, again, how battle tested are you? And as you said, there's going to be some blood in the bath, but I think it's about operating, putting the deal together and getting it to that, I guess the quote unquote finish line of signing that loan. But the real work comes within your first 90-day business plan, and making sure you're making good on everything in those presentations that you had. I always like to, I pride myself on saying, hey, I have, investors and, lenders that will come to me on projects that have failed or failing. It's like, hey, will you take this over? And I'm like, oh, yes, because I know how to operate. And I guess my story is a little bit different because I was kind of behind the curtains. So you have to really know how to operate and asset manage when you're working with different property managers and, knowing metrics, kind of seeing the red flag with different property managers. How do you know if, your rental increases and changing cultures of buildings? So there's a lot that this goes into operating the building outside of just go this pro forma. We're going to raise rents, $150. We're going to charge for valet trash. That all sounds good, until you're actually in the thick of things and you really have to execute it.
Yeah, that is the truth. A lot of deals have been underwritten with aggressive performance, not enough reserve, inexperienced operators, and then of the day, some of the assets that they've acquired have some fundamental challenges, and they need real repositioning, and then there may be property issues, and there's a lot of hard work which not many people prefer to do. And the other thing you mentioned, that battle tested. Well, I don't know too many battle tested operators who started after 2008. It's been a kind of most people has been an upwards journey, because the market supported, let's just call them not perfect execution. Of course, we've done a lot of work with vertically integrated, really experienced folks that are battle tested, but they haven't seen the downturn. That's my point. The downturn has been very limited, other than the short duration during COVID, and then it was short-lived, and suddenly things got, the march continued. So the battle test in this context is seeing a real recession. And by the way, the situation we're experiencing right now hasn't been seen in a long time. For 40 years, interest rates have been dropping, and suddenly they pushed up. So it's a
Well, 2009, they were, I was getting rates at 9%. So when you look at 2009, and I kind of again go back to your experienced operators like that, your Bruce Frazier's that are out there, your Ashley Wilsons, those have kind of been through that system, and there's a group, like I said, that have been through like the high interest rates and knowing how to operate those high interest rates. And like I said, even you have a valid point about going through COVID and the downturn, but yes, you're right. Historically, I would say interest rates are, to me, again, this is subjective. If you look at you take a robust look at interest rates over time, you have this blimp in time where interest rates are at 2 to 3%. I would call that an anomaly if you're looking at the grand scheme metric. So historically, interest rates have been between 6 and 9%. In the 80s, maybe at 14. But one might say, guess what? Interest rates are actually coming back down to where they need to be, and we were just at an anomaly for that period of time. You just look at robustly at interest rates throughout time.
Yeah, that you absolutely bring up the right point. We can do a debate on this. I'll give you my opinion on the subject. And yes, historically the interest rates were much higher. In the 80s, late 80s, they obviously were way higher, and certainly for some folks have experience looking at the interest rates where they are now, even way higher. The big difference, by the way, between that time and the time now, the amount of debt in the system was substantially lower, including debt to GDP ratio. So, and both public and private debt relative to the size of the economy, both private and public and private enterprises were way lower. So in this environment, we're facing the interest rate normalization, which has happened really, really fast. Going from 0 to 5 is not 5% increase. If one of the ways to think about this is U.S. Treasury was at 1/10 or 1% at the bottom of the COVID crisis, the worst part of it.
Yep.
And now it's shot up to 5%. So it went up 40-fold or 49-fold or 50-fold. So some experiences are such that theoretically these rates are not necessarily high on a long-term basis, but in reality, where we were just a little while ago, that's what I'm saying. The system needs time to adjust, and the Fed has not given us the time. So without spending too much time on this, let's go back to kind of what are you doing today, and kind of what's your journey, and how you're working with folks. What are the alternative opportunities? And in this environment, by the way, the syndicator of yesterday and folks who are doing it from a year ago, 2 years ago, they struggle mightily in this environment to raise capital. Many of them, especially have trouble deals, they're going to have difficult time raising capital from investors who are caught on the past deals. They got hurt, they're being hurt, and going to get fresh capital raised is not an easy exercise, because a lot of new investors are very cautious today. So what opportunities you're seeing? I'm just curious. What do you think, where the great deals are, and what do they look like in this environment?
So the great deals that I'm finding, because I am doing and still purchasing, I'm actually still getting Freddie Mac loans I'm doing a refi at a 5.3 right now for a building in Houston. But I find that the mom and pop sector, you can still find solid deals that's going directly to mom and pops. And these are like, I would say, mid-sized deal. They're between 60 and 100 units. So they're not their larger ones. And depending on what market you're in, these purchase prices are anywhere between 10 and $15 million. Right now, you can go to a smaller secondary market. You may find some within the 5 million. But right now, I find that to be kind of a sweet spot because these are folks that have owned it, for some umpteenth years, like sometimes 20, 30 years. And they're just looking to, pass on some cash to their own children or their grandchildren, or in some cases, a lot of children don't even want nothing to do with the business at all. So I've been finding really sweet spots within Texas, kind of going directly to mom and pops. So even right now, I have a 94 unit and 101 unit that are off market in Lubbock that have been owned for well over 25 years each of those. What I've been staying away from is the properties they're still high because they're trying to cash out of the money because they're behind. Those are ones where I'm not seeing any deals at. But the mom and pop sector that own it, I'm still seeing deals in that. Now, again, we talked about the interest rates. That's always the big thing. Can you cover the debt service? You can do your capital improvements, and that's always the tricky part, is finding that sweet spot where it is covering the debt service and you're actually delivering on your investors. I'm not seeing cash on cash returns at 7%. I'm seeing anywhere between honestly 3 to 5%, cash on cash returns that folks are really giving, 13 to 14% IRRs. I'm not seeing any more when people are like 20% IRR returns or 8% cash on cash. I avoid pref altogether, just because I don't like to put the deal where I'm giving the investors the pref. I want to make sure that we can just kind of deliver on just great returns in and out. And I'm holding for a little bit longer now. I'm proposing the deals for 5 to 7 years instead of 3 to 5 years.
So that's interesting. I appreciate the explanation. So a couple of things. One, I actually like the fact that you're setting investor expectations for more conservative returns, which is on equity, which is the truth. When interest rates rise, typically returns on equity fall, unless, of course, you find phenomenal deals, right? So
Yeah.
the opportunity today is to find distressed sellers. What you explain is a little different. You go into a traditional route that's been around for a long time, older, tired sellers who are ready to exit, and you can still get a pretty good deal from them.
Yeah.
But it's not like a distressed seller when the interest rates are hurting them. If they don't sell, the bank is going to take the asset. So it's a distress, but it's not a real distress. There's some kind of seller motivation, but not like a terrible seller motivation, because if they don't sell, right, the bank will foreclose. So, but I do like kind of your comment, which is very real. Your comment is absolutely on the point that the cash on cash returns on a forward basis are low. If you're buying a property, and multifamily trades still at pretty low cap rates, and you have to borrow quite often at the rate above the cap rate that you're paying for it, right? And when you do that, you have a negative impact on the cash flow. The more you borrow, the worse the cash flow gets, and you actually can't service the debt. So getting 3-5% cash on cash that's the real world, right? That's what it is today.
You're hitting it on it, because I didn't mention that, but I'm seeing with some of the lenders, they want you at 35% loan to value when it used to be 20 to 25%. They want a minimum 35% loan to value, and then also the DSCR, your debt service. A lot of lenders are looking at 1.40 minimum, where it used to be 1.25, and when you have you need to hit a 1.4, it's like, whoa, you're like, it makes things really hard to find a really good deal, so you go through a lot of things, a product and underwriting to actually find a quality deal.
Yeah, great point. Well, I really appreciate that, because this is what we're seeing too, that the leverage is reducing. So 35% down means maximum leverage of 65. This is the good old days, right? And quite often, on number of deals, I even heard 50 to 60% leverage. That's it. And the reason for this is because the banks, you can't meet that increased DSCR. At 1.4, it's such a gigantic debt service coverage ratio. It's safe for the bank, but for you as an investor, it's mean, it's
hard.
the risk is reduced on both sides, right? The risk is reduced on the bank side and reduced on the investor side because of a low leverage, but it requires a whole lot more equity. And returns on equity are naturally typically reduced for the reason that you have low leverage and you have to pay high interest rates. So, yeah, that's a great point. So where are you looking for the properties? I mean, you're in Philadelphia. Are you looking to buy in the kind of the Sun Belt? Are you looking mostly in Texas? You said, if I heard,
Yeah,
kind of
I'm in.
Western Texas.
Yeah, I do predominantly red states. I do that for a reason, just because they're more landlord friendly. And so I am in Texas and Georgia. I'm in Kentucky. Those have been kind of my three main stomping grounds. I will do Pennsylvania, but I stay out of Philadelphia County where I've kind of made my mark. It's just because it's just too tenant friendly, and if I need to make sure I'm getting rental income to give to my investors. So those are some of kind of like my rules of thumb of why I like the red states to invest in.
Yeah, makes sense. I'm in New York and probably has the worst tenant landlords in the country. If you are the tenant, you feel like a landlord. And I'm dealing with some of them. That's what they feel. They feel that their rights are such that you're the landlord serving them. It's kind of crazy how the world in
Yes.
some of these, but it is what it is. That's why Texas
Yep.
and Georgia make a lot of sense. I hear you. How do you operate? We have only a couple of minutes left, but I'm just curious, how do you operate remotely? Because one of the biggest risks I see with many operators is they are, running a property in Georgia out of Phoenix. So when you're 1,000 miles away, you're relying on property management, and property management quite often, we've seen this again and again. I don't know what's been your experience. Some of them are not that good, and then they start good, then they fall apart. Finding quality property management is a mission impossible. It's very, very difficult. And they'll start like a dating. Everything is fine, but the moment you stop watching them very carefully, they're not doing good work. Properties are not being maintained the way they need to be. Leasing people are not driven. The regional managers don't go out the same way, and before you know, you have some underperformance. You start digging through and you're beginning to understand. You go to the property yourself and like, oh my God, there's trash on the property. People are not taking care of the business. Oh, they rely on property manager, and the property manager is not doing their job. How do you deal with that?
Yeah, you're absolutely right about that. There's a couple ways to do it. Is that one, when you're the asset manager, you're dictating to the property manager how you want your building to be ran. So you should have your business plan. When we close on a building, that first meeting is always in person. We're going over the units, the CapEx plan, and we're actually pointing out, this is actually sometimes a week-long meeting because we want to make sure everybody's aligned of what the needs of the building are, not hearsay through email. Then I move on after that to have weekly meetings with the property management. They have something they have to give to me, which is a morning report that's going to check work orders, traffic flow, economic and physical occupancy. And so we're going through that, and we're just tracking the count. It's kind of like project management. So you want to have your 30-day look. I want to keep you on that schedule. And there's triggers that you can see if the property manager is falling off, because I in fact have fired property managers. I may be firing another one possibly as well, because once you see it start slipping, or it may be a certain individual or director or the regional that was holding things together left, and then you're like, oh, okay, this other person isn't catching on a lot. You can't let it slip. You try not to let it slip, but I always tell people you need to I would say when you first get the building, it is kind of micromanaging. It's a weekly meeting, and then I always meet to monthly. I never move it out any further than that, because anything outside of that, you'll lose track of everything and out of sight of everything.
How often do you go to properties? How often do you go to see each property?
I go to each property at least once a quarter, but I also secret shop. And so when I'm secret shopping, I will send individuals to the property to see, like, is there trash? I've secret shopped that property at one time where I actually had the housing leasing agent actually was like, oh, I'm just too busy. Gave me the keys to the apartment and had me show it myself. And so those are like, some of the red flags that you have to do. Yeah. And so these are some of the things that you have to do. But I always go to the properties once a quarter. I'm physically there. And then I also bring my investors to the property at least once or twice a year, depending on what region we're in, because it could be some hot. But we also give the opportunity for them to actually see the product that they are invested in.
Yeah, that's a great idea to visit the properties. Love that idea. Appreciate your wisdom. Thank you for coming on a podcast. Before we wrap up, how would folks get a hold of you? Is there a good email, website? What's the best way to reach?
Yes, it's a Noel at Crown Capital Corp. That's a CROWN Capital CAPITAL Corp CORP.com. I always respond. I'm really big on that, so you can hit me up. I always respond at least within 24 hours.
Yeah, I appreciate your sharing and appreciate your responsiveness. And thank you for all these nuggets. And it's great that you're going to the properties at least once a quarter. It's not easy to do it when you're 1,000 miles away, but you got to go to these properties. There's nobody better than you being on site. So Noel at all my time. What's the email? Noel at
crowncapitalcorp.com.
crowncapitalcorp.com.
Yes.
Thank you, Noel, and wishing you best of success, and appreciate you being a guest on a podcast. Have a great day.
You as well. Thank you, sir. Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.